lecture, Money Study Group. I'm Jim Munchback, certified financial planner, and I'm the instructor of personal finance at the Bauer College of Business at the University of Houston. And we're about to get started with our course in personal finance. We're going to be talking about investment strategies today. This is actually part two. Last week I kind of lost my voice. So we will do a little review today of the investment strategies that we're teaching in the course. If you're joining us live on Facebook or the YouTube, feel free to leave a comment. Let me know you're watching and listening. If you have questions or comments, please post those now. We're a few minutes early, so we start the Zoom group at 10 a.m., and I'll do that in a minute. But I'm doing a little test, just a little testing today. Yesterday, Apple came out with Apple Ventura. And so I updated all of my devices to be, so you have to update your Mac. I'm a Mac guy. I love my Mac. I'm using a MacBook Pro right now, the super powered. That's the best machine ever built, in my opinion. But anyway, I'm using that. Yesterday, I updated it to the new operating system, the Mac Ventura. So it's got a lot of cool features, and I had no idea. I had no idea that Apple had this going on. I haven't been paying attention. So anyway, yesterday I started doing a little research to see what the new update. It's a pretty significant upgrade or update, however you want to look at it. One of the biggest updates, I think, let me see here, that I wanted to test is using they now have I can't remember what they call it. It's for the phone, continuity camera. So the continuity camera allows you to basically put your phone wirelessly up and use it as a camera. And I wanted to do that. I tried to do that. I'm using a program called Ecamm Live right now, and it's a lot of moving parts. So anyway, I wanted to try it, but I chickened out. So I'm using my old cheap Keo. It's a Keo camera. It's just a webcam, very inexpensive, very not high quality. Definitely not going to give me this camera that I'm using now will not give me the quality that I will get from this iPhone 13 Pro Max. And I got this phone for the camera, and so I'm pretty excited about what's possible moving forward. But like I said, I chickened out. Excuse me, still wrestling with my voice. I wanted to test out, just make sure everything's working. So looks like everything is working. Again, I'm using the old lame camera, but I'm hoping you can hear me with the mic. It looks like you can hear me. Now I'm going to jump into the Zoom room, and I'm going to admit everyone who's waiting. And we will get started with our class today. But first, let me close out some of these screens that are so distracting. Okay, I'm going to admit everyone. Let's see who's here. Hey, good morning. Good morning. Getting started in the Zoom room. Hello, everyone. Looks like we have a pretty good full house. If someone could please just let me know that you hear me, I would appreciate it. Hi, Nan. And it looks like, yes, you can hear me. Okay, great. Thanks, Elisa. I appreciate that. And again, everyone, if you'll just chime in with your name and the time that you joined the meeting, that would be great. We are streaming live on Facebook and the YouTube. And if you go to missionalmoney.com, you'll see that we have the live streaming on the homepage of the website at missionalmoney.com. So we will officially get started here in a few minutes. I'll do a little review today. We will do some review of the 4 investment strategies that we started to talk about last week before my voice tanked. Still struggling with that. It's the time of year every year, this time, I get this stuff. And it goes from my nose to my throat. And if you've ever heard of hay fever, that's what it is, although it sounds and looks like something they call COVID. So people get pretty nervous when they see someone coughing, run the other way. But so anyway, I'm sitting in my studio at my house, avoiding all human contact other than digital contact. So you are now digitally infected with my voice. Okay, enough of that. So we're going to get started. We're going to talk about investment strategies. Before we do that, though, I wanted to make an announcement. I have been asked to make this announcement, and I'm happy to do so. If it will come back on my... Looks like it is playing hard to get. So I was just saying before I opened the Zoom meeting that Apple released this Ventura. If you're an Apple user, you may have noticed that there's a new update for the iPhone, iOS devices, iOS 16, which I updated my stuff yesterday, at least my phone, to iOS 16. And then they have Ventura, the operating system for the MacBook Pro. So if that's totally not interesting to you, then, I'm sorry, but I'm going to spend 30 seconds just to let you know that I updated everything with the new operating system and the new iOS, and it has got some really cool features for someone who creates videos. So I will be testing it soon. I didn't want to test it today because, well, I didn't want to put you through that. So I'm using my lame old Keo camera, which is very cheap, but it works. It's very reliable. I'm using my old Fi-Fi microphone, which hopefully you can hear me just great. Anyway, that's that. Here's the announcement. And this is 25 points for extra credit if you're interested. But hopefully you don't get interested just for the 25 points. If you do, then, well, you have bigger problems than 25 points is going to solve. But it is what it is. So I will give you 25 points if you go to this event. But here's why you should go, or at least why you should consider checking this out. If you are interested in a career as a financial planner, then this is really an event you should go to, not just for the free food, but you can find out about scholarships. And you'll get to meet and talk to some certified financial planners who are actually certified financial planners. You'll also get to talk to some certificate holders. So I'm not going to go into what that means, but basically it takes a lot to become a certified financial planner professional. And that's what I am. My friend John Lopez, he's kind of my boss kind of guy, sort of. He will be there. He is also a CFP, but he's a CFP certificate, and he is in the finance department at the University of Houston. John Lopez, he's my friend, my buddy. He's the reason I got this gig at teaching personal finance, so I love the man. Anyway, if you're interested, you can just point your phone at that QR code. It should work. This one may be a little bit better, but anyway, you can learn more about the event simply by pointing your phone at the QR code there. I posted this in missionalmoney.com, so if you're watching this video and you want to attend, that's the best way to do it. Just point your phone at that QR code and it'll take you to the event where you can register. And if you are interested in the extra credit points, pay attention now. It's 10:05 a.m. So I'm making this announcement about this extra credit assignment at 10:05 a.m. on 25 October, year of our Lord 2022. So please don't email me. This is required. Watch the Zoom meetings so you can get these announcements. 25 points extra credit if you attend this event. The way you'll get those 25 points is very simple. It's not going to be an extra assignment. It's going to just be you posting a little extra in any assignment you choose. So next week's assignment it's actually not until November 4th. So any assignment closely following November 4th, you will simply do a little article, very simple, basic. Tell me who was there, what they talked about, what you learned, why you attended. Okay. And if you attended just to get the 25 points extra credit, you can say that. Be honest. I want you to be honest. But mainly, I just want to know, I'm hoping that some of you are at this point at least beginning to be a little bit interested about the possibility of working in the financial services industry. And if you are, I'm going to tell you that the best opportunities in terms of not just number of opportunities, but in addition, in terms of the ability to really make a difference in people's lives, is the best opportunity in the financial services industry, I believe, is in the area of financial planning. And so, as a certified financial planner, I don't get paid to promote the CFP board or the certification, but I do believe it's the best. It's the best distinction, the best way to distinguish yourself as a financial professional, for lots of reasons that I'm not going to go into. But again, I am a certified financial planner professional. I hold those marks with pride, and I promote those marks with pride because I believe they're the best marks in the industry. And so if you want to learn more about that, I'll tell you additionally, I just wanted you to know that what you're learning in this course as you're building your own financial plan will serve you very well if you're at all interested in checking out a career in financial planning in the financial services industry. Every company on Wall Street, every financial services company that provides investment advice also is kind of required to provide a certain level of financial planning advice. And every company has a different approach to that. But the point is, if you're going to be in this business, financial planning is a really central thing, and you should learn about it. You should understand it if you're going to be in this business. And you should learn about it, obviously, I believe, just as a regular person who's trying to figure out how to make your money count. And that's what we're here to do in this course. So we will spend no more time on this announcement other than to remind you that if you're interested, just click on that QR code or don't click on it. You can send an email to this person that's also in the post, diversityinitiatives@cfpboard.org. So again, the little QR code, point your phone at it, it'll take you there. So that is that. So if you have any questions about that, you can certainly pop those in to the chat but I don't have really any answers about that announcement. That was it. So let's get started. So I want to do a little review. Last week we talked about 4 investment strategies. Really, I introduced those to you. I kind of lost my voice and didn't get through the second half. So we will cover today dollar cost averaging as well as portfolio rebalancing. And I know that you guys learned a lot about those strategies in your homework this week. So that could work out to be a benefit for all of us, because typically when I start to teach investment strategies, I'm working with students who are really just beginning to learn the basics about investing. And in this course, investing is the most popular topic because everybody wants to learn about investing, because investing seems to be the best way, the fastest way, the most effective way to build wealth. And that's not really true, but we can go with that. We can pretend that's true because investing is very important. But what's more important than investment planning is just good old-fashioned financial planning. And so one of the things I would encourage you to do is to recognize the most important thing you can do to build wealth is to earn. You're going to college, you're learning something, and I hope that you're ready to put that into action soon. But the truth is, for students who work, who earn money, that is a skill. It's a muscle that you need to develop. The ability to earn money is fundamental to building wealth. And then after that is saving, which is one of the 3 laws of personal finance, the law of spending and saving. You have to save more, spend less than you earn, so that you can save more for what really matters most. And then as you start to develop that earning muscle and that savings muscle, Then it's time to start looking at investing. And as you start to invest over time, you're going to accumulate wealth because you were earning money, you were saving more money than you were spending, and now you started investing. And that's where this lesson comes into play and becomes very, very helpful. This lesson, last week's lesson, the 4 investment strategies become really important for you once you get to that point where you have some money to invest. So right now, statistically, most of you are probably not in a position where these strategies are going to be super important. But once you graduate, these 4 investment strategies become super important, starting with one of the investment strategies that's not even one of the investment strategies, and that is the perfect investment. So I wanted to just spend a minute and highlight the perfect investment. I thought I had it on my list here, but I do not. So I'm just going to remind you that in addition to these 4 investment strategies, which are listed there, starting with diversification. Remember, we talked about Enron and the company Enron and how so many people got devastated because they didn't follow this investment strategy. They worked at Enron and they invested most or all of their 401k in Enron stock, and they got annihilated when the company basically went out of business. So the perfect investment is that 401k. So remember, we set up the illustration, the scenario, where we assumed that everyone in the group here is making $100,000 a year, and we're working for a company. I think we said we had an 8% match. So again, if you're making $100,000 and your company 401k is giving an 8% match, first and foremost is when you graduate and you start working for that company, and it doesn't have to be that company, it can be any company that has a 401k that includes a match. You need to know how much is the match that your company is offering. Because first of all, HR on day one, they're going to set up the benefits meeting with you, and you're going to have to make some choices. And when they get to the question of the 401k, your choice should already be made. Your answer to the question, do you want to participate in the 401k, is obviously yes. The next question is, how much do you want to contribute to your 401k? And the answer should be already solid in your mind, because when you interview for that job, when you're going for that job, hopefully you did a little research to find out what benefits do they offer. If you haven't done that, then, well, you should. Okay, so I'm assuming that you will, that by the time you interview for that job, you're going to know what the match is in their 401k. So on day one, when you meet with HR and they get to the point, how much are you going to contribute to your 401k? The answer is already calculated in your head because, excuse me, because in order for you to take advantage of the perfect investment, you have to know what the match is, because that match is the perfect investment. You're not going to find a better deal on the planet anywhere in terms of what to do with your money to build wealth better than the perfect investment, which is simply taking advantage of the 401k match. So again, the scenario, we're all making 100 grand. We're working for, let's say, Shell Oil, and they have an 8% match. I actually met with a client this week who works for Boeing, and Boeing has a 10% match. So let's change our scenario. Let's use Boeing, because that's a real company, and I'm working with a real client who has a real 401k that provides a real 10% match. And that match applies whether they go with the 401k tax deferred contribution or the 401k Roth. We're not going to get into that today, but next week we're going to talk about types of accounts. And a 401k, again, in review, is a type of account. It's not really an investment. It's a type of account that you put money into, that you begin then to take the money that you put into that account, and you have to choose how you're going to invest it. And that's what we're going to talk about as we look at these investment strategies deeper today. But in review, The perfect investment, the 401k match, is that amount of money that you put into your 401k account, and then the company comes behind you and they match whatever their 401k plan allows them to match. So if you are working for Boeing and they have a 10% match, and let's assume we make 100,000, how much do you have to put into your 401k to take advantage of the perfect investment? Somebody give me a number there. Now, again, we changed the scenario a bit. Just want to make sure you're paying attention. We're working for Boeing. Boeing has a 10% match. We're all making 100 grand. So in this scenario, how much do you have to contribute to your 401k to take advantage of the perfect investment? Yes, the answer, Tika, is 10%. Elisa, it is 10% of 100 grand, which is how much money? How much is 10% of 100 grand? I keep these numbers super simple because math has never been my strength, really. So yeah, $10,000. So the answer to the question, how much do you have to contribute to your 401k in the scenario we outlined? You're working for Boeing, you're making 100 grand a year. How much do you have to contribute to get the perfect investment to work for you? And the answer is very simple. It's 10%. So let's take that a little further. So we all know now that if you work for Boeing and you're making 100 grand and you want to take advantage of the perfect investment, you have to put in 10 grand of your own money. You have to have that deducted from your paycheck to go into your 401k account. Now that the money's in there, what happens throughout the year? What does Boeing do? What do they contribute to your 401k account in that scenario that we just outlined? Working for Boeing, they pay 10%. You have to contribute 10% first in order to get their match. You have to contribute the full 10 grand. And then what happens? Also 10 grand. Yes, Jessica. Yes, Tika, they match the amount. Only if you put in the amount and only up to the amount of the match. So in this example, again, Boeing has a 10% match. You're making 100 grand. If you put in 5 grand, how much are they going to match if you put in 5 grand? So you're all right. Everybody's right who said they will put in 10 grand if you put in 10 grand. But what if you only put in 5 grand? Tika, Jessica, yeah, 5 grand. That's all they're going to match is the 5 grand. And that's why it's so important. Like if I could teach you 2 things this semester, one would be build an emergency fund. Start now. If you only have $500 in the bank, cash money in your underwear drawer or whatever, wherever you keep your cash, I keep it in my motorcycle trunk, so I know where it is. But that's not true. I don't keep my emergency fund there, but I do keep several $100s there just in case. It's kind of like my extra emergency fund. But you need an emergency fund that equals at least like 3 months of your income. That's a good number. 6 months is better. The more wealth you have, the more income you make, the bigger emergency fund you need. And even now, if there were 2 things I could teach you that I knew you were going to do as a result of taking this course, number 1 would be build a better emergency fund. It's just critical to your financial future. Number 2, number 2 is this, the perfect investment. And so again, if you're making 100 grand working at Boeing, they offer a 10% match, but you choose to only put in 5 grand, you're leaving $5,000 on the table. Not to mention, when you contribute to your 401k, typically, if it's the 401k, the traditional 401k, you get a 10%, you get a tax deduction for every dollar you put in. So in other words, instead of paying tax on 100 grand, how much would you pay tax on? If you, in this scenario, work for Boeing, you make $100,000, they match 10%, you put 10% in, 10 grand. How much are you going to pay taxes on at the end of the year? Yeah, 90 grand. That's exactly right. You guys are right on. So enough review of the perfect investment. The reason I want to pound this into the course, into your plan, is a couple of reasons. Number one, when I start to teach you these investment strategies, they work best in your 401k. And because you have that match going on, they work even better. And I promise you, one of the best, not one of, the best way to build wealth is to follow these 4 investment strategies and make sure you're using them in your 401k. That's relatively super easy for you to learn how to do in terms of being financially responsible, in terms of building wealth, in terms of having an awesome plan for your financial future. These 4 investment strategies wrapped up in the perfect investment. It doesn't get any better than that. There's nothing out there that is more sophisticated or more innovative. It's not crypto. It's not learning how to invest with options. It's none of that stuff that may seem so appealing or so cool. It's not. It's simple, basic 101 stuff. The perfect investment, your 401k match, and learning how these 4 investment strategies work. So hopefully last week you guys paid attention as you learned about different asset classes, because asset classes are critical to my iPad went to sleep. Asset classes are critical. I told you that we started talking about the 4 investment strategies. We covered diversification pretty well. I talked about asset allocation a little bit. I told you this about asset allocation. I told you that it's the single most important determinant of your portfolio's returns, and it is. Nothing's going to make a bigger difference in your portfolio than your asset allocation. And you can't really know what that means if you don't understand the difference between a large cap stock, a small cap stock, a government bond, a corporate bond. Each of these are asset classes. Cash is an asset class. Cash happens to be one asset class that's supposed to have no risk. Like government treasuries are thought to have no risk. So fair enough. Let's say that that's true, that cash and government treasuries, U.S. government treasuries, it's like having cash. They're not that different. The government prints it, and they can print unlimited amounts, but it's backed by the U.S. government. So whether you're holding a $100 bill in your hand or a U.S. Treasury in your account, your 401k or whatever account you have, those 2 assets are like cash, and they're considered to be the least with no risk. But the truth is, if you know anything about inflation, there is risk. If you keep all of your money in cash because you're afraid of risk, you're risking something that's going to be guaranteed to hurt you, because you're risking inflation going up faster than the value of your cash, because cash doesn't go up, it doesn't go down. But inflation makes the price of everything go up. And if you haven't been paying attention to the news, I voted yesterday. I hope you guys vote. If you can vote, I hope you're registered to vote. I hope you vote. And I hope you understand that when you vote, one of the things you're doing is you're making a choice. You're saying, I cast my vote for, basically, in my view, there are 2 ways that make me think about voting. One is bigger government, more free stuff. And that means the government prints more money. They print more money. They create more money. They just print it. And when they do that, we have what we have today, which is inflation. It's pretty much that simple. Debt has to be paid back. The U.S. government, even though they're printing all that money, they have to pay on the debt, and that creates inflation. It lowers production. And when you vote for government, I vote for smaller government. I don't care which party it is. I want smaller government. Government wastes more money than anything in every country, and politicians want to spend money. So if you just think about it like that politicians want to spend more money because they want to earn more votes, that's what makes them not have any restraint in terms of the law of spending and saving. They spend way more than they receive in taxes. So just think about that as you vote, that one of the things that's happening is politicians promise stuff like loan forgiveness for student loans. And who pays for that? That somebody's got to pay for that. And that free money creates inflation. So cash is an asset class that you may think has no risk, but it has a lot of risk, because inflation, we have 10%, 8%, 9%, whatever it is, inflation today. And that means your dollar is worth 8 cents less than it was yesterday. And if that goes on, then that dollar becomes worth less and less and less. And that's why it's important for you to understand asset classes, because those asset classes that you put into play in your investments, they all go up and down in different ways. And so I want you to understand the difference between cash, between a bond, between large cap stocks, small cap stocks, international stocks. I think one of the biggest opportunities moving forward is going to be small countries in like Central America, countries that are growing, well, the short answer is countries that are using coal for energy, the dirtiest fuel on the planet. As they go for that low cost energy, they're going to have higher production. They're going to have smaller margin. It's going to cost them less to do the things they want to do. Energy is involved in everything. And countries that decide they want to, go for the green, everything's green, that's just a very, very expensive way to run stuff. And so as you start to think about asset classes, that's one of the things you can start to do, is think about, okay, we've got asset classes, and we've also got different things that drive the price of those assets. And commodities is one of the things that is an asset class. Oil, sugar, coffee, these are commodities. So I don't want you to become an expert tomorrow on asset classes, but I want you to understand the difference between different asset classes. Just start to make mental notes that those are different, and they respond differently to market forces. So I see a question, Elisa. It is also, we will risk the return or interest rate on the money if we keep them in cash. Yes, that's true. So if you keep your money in cash and you don't invest it in something that yields a return, like a bond, then you lose your cash. But the truth is, this year, I don't know if you guys know this, in 2022, so one way you can invest your money to get a yield on the interest is to invest in a bond. A bond is different than an equity. It's different than a stock, but it pays you a coupon. It pays you interest. And what happens with bonds, the value of the bond, is when interest rates go up, and I don't know if you guys pay attention to this, but trust me, this year interest rates have gone up at a rate I've never seen in my lifetime. And as interest rates go up, the value of bonds goes down. And so that's one of the reasons that people this year especially are saying, hey, if you have cash, if you have money in cash, you've done better than any investment, any asset class, which is actually true. Because even though bonds are considered to be safer than stocks, this year, 2022, bonds have performed worse than they have since 1931. I could show you a chart. It's kind of scary to see how much bonds have come down. They've come down every bit as much as stocks, even more in most cases, because interest rates are going up. Why are interest rates going up? Because of inflation. Why has inflation skyrocketed? Because governments around the world are printing money like there's no tomorrow, and they're actually putting it into your accounts with stimulus checks and loan forgiveness and free money that creates this incredible inflation. So, I mean, it's all kind of tied together, and it's happened so fast this year that so many asset classes have been shaken up. And for many people, like who are my age, what's happening in their 401k and in their other accounts is scary. And so fear makes people make mistakes. And I know that some of you are afraid of taking some risk in your investments because you don't want to lose the money. So this next strategy that I want to teach you, it goes beyond asset allocation. Asset allocation is still the single most important determinant of your portfolio's returns. And over time, even though we have years like we've had this year, over time, these asset classes tend to go up and up. And so what I'm about to teach you is the most powerful investment strategy that you can use to build wealth over time. There's no more powerful investment strategy to help you build wealth, especially in your 401k. So I hope you'll pay attention as I teach you about dollar cost averaging. So it's the third investment strategy, dollar cost averaging. So to do that, I want to tell you a story about Farmer Joe. Farmer Joe is a client of mine, and he called me up one day some time ago, and he said, Jim, I'm thinking about investing in cows, and you're my financial advisor, so I wanted to talk it through and come up with a plan. So the plan that we came up with was based on the fact that cows are a pretty good investment for a farmer because he's got the land, he's got the barns, he's got the tractors, he's got all the stuff you need to raise cows. I mean, it would be different than me investing in cows because I can't have a cow in my backyard or my kitchen, right? But Farmer Joe, he had the facilities for cows, but he didn't have any cows. He had chickens, he had pigs, he had all these other things that produced income on his farm, and he was pretty good at running a farm. And so I'm like, dude, yeah, that seems like why haven't you done that before now? He's like, well, they told me all the reasons why, but the point was the price of cows, which by the way, it's a commodity. It's like oil or sugar or you name it. These commodities are what drive the prices. If you've gone to the store lately, you might notice that if you want to smoke a brisket or cook some hamburger or have yourself a nice ribeye steak today, if you go to Costco to buy any of those meats, any of those proteins that come from cows, you'll notice that the price of those proteins are significantly more than they were 2 years ago, way more. So I smoke a lot on my Traeger smoker, and I notice the price has gone up. And most people around the country have noticed that not only has gas, which is a commodity, gone up in price, but so has food. And food involves different commodities, like pork bellies is a commodity. And anyway, Farmer Joe decided he wanted to invest in cows. I'm like, it's not a bad idea. So he made a plan. He said, look, let's invest $100 a month. This, what I'm about to share with you, is how dollar cost averaging works. And I'm going to use Farmer Joe, and his cows to illustrate how it works. But what I want you to think about is, let's pretend we're not just investing in cows. We could be investing in cows, pigs, chickens, hay, fuel, tractors, it doesn't matter, but think about asset classes. And so I'm going to teach you this lesson about dollar cost averaging using cows with Farmer Joe. But what I want you to think about is your 401k over here that you're investing in. And I want you to think about having, 4 different asset classes. Something simple like large cap stocks like Apple, Coke, McDonald's. That's, say, 25% of your portfolio. You don't have a farm, but you have a portfolio. And you have to decide in that meeting with your HR person, do you want to participate in your 401k? Yes. How much? However much they match, at least. And then you're going to have to tell them, how do you want to allocate your assets? So what I'm about to teach you with Farmer Joe and his cows is how asset classes work and why asset allocation is so important, but why, in my opinion, the most powerful strategy you can put to work in your investment plan, in your investment account, and your 401k for a young person who has a long time to invest. There's no more powerful strategy than dollar cost averaging. It will help you build wealth more than anything. Now, granted, you have to have good asset allocation. That's like comes before dollar cost averaging. But once you have that set up, once you've selected how you're going to allocate your assets in your 401k, it becomes automatic. This dollar cost averaging, it's a strategy that you preset, and it works all by itself, and it works like magic. And here's how it works. So Farmer Joe decided he was going to invest $100 a month in cows, just like you're going to decide that you're going to invest in whatever asset classes you choose in your 401k. You're going to be contributing to those asset classes twice a month. Like every time you get paid, money's going to come out of your paycheck and go into your 401k, where that money in your 401k is going to reach out and grab some of those asset classes. Let's pretend they're cows just for a minute. So that's the same strategy in your 401k as Farmer Joe is using on his farm, except he's using cows. And his strategy involves $100 a month. That's his strategy. That's how he's going to use a systematic plan to buy cows. So first of all, he has month number one. How much is he going to put in? $100. Because that's how much he's going to do every month is $100. So how much do you think cows cost in month one? The first month he does this, cows are $100 per head. I think that's how you buy cows, per head. Okay, so I got that out. So if that's true, if month number one, Farmer Joe decides he's going to invest in cows with $100 a month systematic investment, how many cows is he going to be able to buy during month number one? Anyone got an idea? I want to make sure you're paying attention. Thank you, Tika. I'm not going to say it out loud because if you're watching on Facebook or the YouTube, I want you to answer the question. Month number one, Farmer Joe makes a plan, a systematic plan to do dollar cost averaging, $100 a month. He's going to invest $100 a month on cows. And it just so happens that the first month he does this plan, cows are $100 a head. So how many cows is he going to buy? One. Again, think about your 401k. Let's say you have 4 asset classes: large cap, small cap, international, and bond. Simple enough, right? Large, small, international, and bond. And let's just say that bonds are tanking like they are this year. How many bonds would you get? You'd get more for your money, right? Same thing with cows, except this time cows are $100 a head. Month two comes along. And cows are $50 a head. So you can look at the screen and you can kind of figure out the answer to the question I'm about to ask. How many cows does Joe get in month number 2? He's committed to a systematic plan, a strategy called dollar cost averaging, which involves him spending $100 a month investing systematically in cows. The first month they were $100 a head. The second month they're $50 a head. How many cows is he going to get? Thank you, Jessica. Thank you, Elisa. Thank you, Tika. Thank you, Sahil. You guys all got it right. It's not rocket science. And this is exactly how dollar cost averaging works. And you're going to see why it's so powerful. So then month number 3 comes along and cows drop to 25, kind of looking like bonds now, right? My bond portfolio, it's in painful disarray today because interest rates keep going up and bonds keep going down. Well, something's going on with cows. And now in month number 3, Joe continues his strategic plan, his systematic investment, his dollar cost averaging strategy of $100 a month in cows drop to $25 a head. So what do you think I'm going to ask next? How many cows does Farmer Joe buy in month number 3 when cows are selling for 25 bucks a head and he's committed to spending $100 a month? Thank you. This is getting too easy, right? It's a little bit obnoxious maybe that I keep asking these questions as if it's not so simple, that it's right there in front of your mind. But let's just go one more month and let's say that cows drop all the way to 20 bucks a month. And I'm just going to ask the question one more time. I'm not even going to ask it. I'm just going to wait for you to answer it. So just, yeah, you guys are awesome. Thank you. Thank you. You got it. Because he's spending $100 a month and cows drop to 20 bucks a head, that's pretty simple math. Even I can do it. $100, 20 bucks a head is 5 cows in month number 4. Now you can see what happens. The price of cows, kind of like bonds, I hope, it bottomed. It bottomed 20 bucks a head. Joe started out spending $100 a head. Now, this is when the phone rang. Farmer Joe called me up and he's like, Jim, this is crazy. I'm freaking out here. You got me into buying cows. I'm like, whoa, Joe, wait. Remember, we had a conversation about why it made sense to invest in cows, the milk, the leather, the beef, the fact that you have all these facilities for raising cows already. You've got a nice, you got a whole fleet of tractors and you've got the hay production going on. You got all this. Come on, Joe. Don't blame me now. Look, listen, think about it. Stop. Take a deep breath. Today, because Joe, what do you think Joe wanted to do with the cow business at this point? With $20 a head cattle, instead of $100 a head where he started this plan, what do you think Joe wants to do? What would you want to do with all your cows after they drop that much? Tika, you want to make a profit? How are you going to do that if cows are 20 bucks a head? How do you do that? That's what you want to do. That's why you invest, Tika. But Joe is calling me scared to death, and he wants me to sell his cows and get out of the cow business. And Tika, you're right. Investors want to make profit. Joe, the farmer, wants to make profit on his cows, and I'm his advisor, and he's scared because the price has gone down and down and down and down. And this is where dollar cost averaging becomes super powerful for building wealth if you don't do something stupid. In fact, what I told Joe, let me see what you guys said. So Elisa, that's right. I'm going to come to that. I'll talk about your comment in a minute. But first, a word from our sponsor. No, I'm kidding. No sponsor. But first, I want to tell you what I told Joe. I'm like, Joe, look, I re-outlined all the reasons that it made sense to invest in cows, and none of that had changed. People still wanted beef. Yeah, the price of beef at the store was way down. His profit margin was way down. But I'm like, Joe, look, the best thing you could do right now is go sell your tractor. Go sell a couple tractors because the price of tractors is all-time high. Because you know what happened with COVID? It wasn't even with COVID. It's just there are only so many people that can fix a computerized tractor these days. And so when the farmer needs his tractor, he needs his tractor. The old tractors, a guy like me could fix. I could go figure it out. I could fix it. But the new tractors, the really expensive tractors with all that computer stuff because of the chip shortage and the shortage of expert specialists who can go out today and fix my tractor when I need it to be in the field because it's harvest time, it's critical, but there's only so many people that can come and fix my tractor because of all the computer stuff. Well, Joe had some old tractors that he bought and he had extras, and the price of those old tractors was through the roof, like ridiculous high, because farmers all around the country wanted old tractors, not new tractors. So I'm like, Joe, sell your tractors, buy more cows. This is a great opportunity to buy more cows. Well, he didn't like that idea. At 20 bucks a head, he said, let's just keep with the plan. So the next month, cows go to 25 bucks a head. And what do you think he does? He buys how many cows with $100 a month, systematic investment. How much do you think he gets? Come on, you guys. Elisa said before she had the comment, keep the cows and wait for the price to go up. He did that. That's what I told him too. I said, the price of these cows is not going to stay 20 bucks a head. Just like I remember back when oil, another commodity during COVID, it dropped to negative $20 a barrel because nobody could find storage for the fuel, for the gas, for the oil. And so I'm like, it's a great time to be investing in oil because I promise you, you're never going to find it cheaper than negative $20 a barrel. They were literally paying people on the futures market because they couldn't store it. The cost of storing oil had gone through the roof because every vessel on the planet, every place you could possibly store oil was full to capacity. There was no storage. So oil, they were paying you to take it. Imagine that. It lasted like 3 minutes, but still, the point is wait till the price goes up. Don't freak out. Don't let fear make you make a big mistake because the market has dropped so much. It's what I'm telling my clients today with their bonds. Let's not make a mistake. Let's wait. And so that's what we're doing. And it's painful. It was painful for Farmer Joe, but he waited and the price went to 25 bucks a head. And yes, he got 4 cows in the, what month is that? 1, 2, 3, 4. The 5th month, cows went back up to 25 bucks a head. And then guess what happened in the 6th month? They went to 50 bucks a head. And you guessed it, he was able to buy with his $100 investment. Thank you, Nan. 2. She's way ahead. You're way ahead of the game. So in month number, we got 1, 2, 3, 4, 5. Month number 6, he got 2 more cows. And then finally, in the next month, cows are back up to 100 bucks, 100 bucks a head. Let me fix that. So back to 100 bucks a head. And that's month number 7, I guess. And that's when Joe, he called me again and he's like, Jim, look, I want to rethink about this plan because the price of cows, it's kind of volatile and I don't know what to expect. And it just scares me. I'm not sure I want to invest in cows anymore. I'm like, okay, all right, now, Joe, back to what you said, Tika. Joe's goal was to make a profit. So I'm like, okay, Joe, you want to get out of cows? I get that. I don't want any more angry phone calls. I don't want to have to hold your hand, when we have these kind of opportunities. When you're feeling the way you were feeling, that's hard for me too, because I love you, bro. And so as your advisor, I think it may make sense now to take some profit. Now let's talk about that. Remember, Joe committed to $100 a month, systematic investment of $100 a month. Price of cows started at 100 bucks. The month after, they dropped in half, and then they dropped down to 25, dropped in half again. Then they dropped by another 20% to 20 bucks a head, and then they started creeping back up. So by month 7, cows were back where they started at 100 bucks a head. Now, if Joe would have taken all of his investment and bought cows when he wanted to buy cows, he would have been even. And he would have experienced a tremendous amount of frustration and headache and pain and fear and anxiety because he would see the value of his investment go down, down, down. But because Joe chose to use dollar cost averaging as his investment strategy, and he committed to $100 a month systematic investment, just like you're going to do in your 401k, exactly the way you're going to do in your 401k. Except you're going to have different asset classes. It's not going to be commodities, cows, chickens, pigs. It's going to be large cap, small cap, international bond, whatever you choose in your 401k. But Joe, he chose dollar cost averaging. Now we're at the end of 7 months and it's making sense that this is probably not the best investment for him because it's too volatile. It's like oil. Oil is, you can make a lot of money in oil, but it's very volatile, goes up, goes down. And if you don't know that, you should maybe figure that out at some point before you start investing in it. Okay, so now let me ask you this. Joe's invested $100 a month. That was his commitment. How much has he invested? How much did Joe invest? For 7 months. So $100 a month times 7 months. Somebody answer that. I'm going to play around with my... So he's done 7 months at $100 a month. Tika, Jessica, Elisa, you guys are right. And who else is there up there in the chat? Sorry, I don't want to miss anybody. Nan, thank you very much. Everybody that's commenting, I'm not hearing from so many of you, which makes me think probably you're watching Netflix, but that's okay. I'm going to pretend that I don't see that. So thank you for those of you who are commenting. So yeah, $100 a month for 7 months is $700. That's pretty easy. And now let's look again at the chart. This is the cow accumulation chart, and that's a pretty ugly chart because I scribbled all over it. But if you can look at that chart and just count the cows, yeah, Nan, you're right. Nan's telling me how much the revenue was when we sell these cows. But first, Nan, let's just simply count the cows, because you're absolutely right. You're way ahead of the game, but I appreciate that too. But just so everybody knows, how many cows did Farmer Joe accumulate over the course of the 7 months while he used this strategy called dollar cost averaging? It's a remarkable strategy. The price of cows never went over $100, went all the way down to $20 in 7 months with $100 systematic investment, a commitment of $100 a month, month after month after month for 7 months. Joe accumulates how many cows at $100 a month? How many cows? The number of cows that Joe has. Nan, you're ahead of the game with the amount of revenue, which I'm going to have to say going once. Anybody, please comment. How many cows do you see on the screen right now? It's not that difficult. You're right, Nan. 19. So Nan's the only one with the number. It should be easy to count those bad boys. Let's just go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. So yeah, we have 19 cows. Nobody else is going to answer that question apparently in the chat. So maybe I've lost you to Facebook, YouTube, somewhere. Anyway, come back. Chime in, leave a comment if you're watching on Facebook or YouTube. How many cows do you see? It's important that you know that, because, yeah, Tika, 19 cows in 7 months. And how much, when we sell all of these cows today, because Joe wants to get out of the cow business, he also wants to make a profit. So when he sells 19 cows at $100 a head, how much of a return, how much revenue, how much income, how much money is he going to have from selling his cows? $1,900. That's right. And how much did he invest? How much did he invest in these cows over 7 months with his systematic approach to investing called dollar cost averaging, where he committed $100 a month systematically to buy cows, and the price of the cows varied. So over the 7 months, he was able to buy more or less cows each time the price changed. Yeah, he invested $700 because he committed to $700 or $100 a month. Think about your 401k. When you signed up, how much are you going to commit to invest? You're going to commit to invest however much the match is. And the company is going to come along and match that, which means you're really investing twice as much as you invest. If it's a 10% match, instead of 10 grand in your 401k at the end of 1 year, how much will you have in your 401k at the end of 1 year? If you invest $10,000 and the company matches that $10,000, how much is in your account? 20 grand. Thank you, guys. So I want you to think about Farmer Joe, he committed to $100 a month. You guys are committing to invest whatever that match is. In our scenario, it's 10 grand a year. That's like what, $750 a month. I'm going to do my calculator real quick because I'm really not that great at math. So I'm going to go to my calculator and I'm just going to say, okay, $10,000 divided by 12 equals $833. So you guys aren't going to commit to $100 a month. You're going to commit to $833 a month, and your company is going to come along and they're going to chunk in another $833 a month. So just imagine if you happen to have the opportunity in your 401k to buy cows, and you were doing $833 a month, and cows were $100 a head when you started. And over the 12 months, they went up and down and up and down and up and down, and not just 12 months, but say 2 years, 5 years, 10 years. How many cows would you have? Dollar cost averaging would give you a whole lot more cows than if you just took the money at the beginning of each year and bought the cows. If you did it over the month after month, in fact, in your case, you're going to be doing it every 2 weeks because you get paid every 2 weeks, which gives you more opportunity to take advantage of the ups and the downs of the market. So when I say the ups and downs of the market, let's just take a look at, so this is a bond. This is government 20-year government bond. See what this is like, cows at $20 a head. This is a 1-year chart of the TLT, which is 20-year bonds, 20-year government bonds. Can you imagine going down that much? But let's look at the max chart. That's brutal. I mean, that is like, when I look at that chart, I think of these cows and I think, okay, it's like this. It's like you can buy 5 cows for the same amount that you could have bought 1 cow for not that long ago. Now, that's just one chart of bonds. It's an ugly chart. I own a lot of that. And I bought some more yesterday, not just for myself, but for my clients, because that chart shows me that the value of bonds is so far down that it would probably make sense for me to go sell some Apple stock and buy some more of it, which seems really crazy, but it's true. Just like I told Joe, you should sell your tractors and buy more cows. My point is, you are going to go through ridiculously crazy, volatile, scary times in the market. Dollar cost averaging is going to be your best friend. I don't want you to be afraid of risk. I want you to embrace it. Volatility in the market, just like the price of cows, there's going to be so many things that makes the market go up and down. Up a lot, down a lot. Let me look at one more. I'm going to show you the S&P 500. This is, if I think I told you, if I could invest in just one investment, it would be the SPY. It's an exchange traded fund. It replicates the S&P 500. That's a maximum chart for as long as this ETF has been in existence. Look at that chart. Look how high it was at one point. Now let's look at a 1-year chart. Think again about cows. Look at how the price of these cows has dropped. You know, when that got down to, what is it, $350 a share. Today it's trading for $383. It's up 1.23%. But if you would have called me and, believe me, I was thinking the same thing Farmer Joe was. I got to sell. But it'd be a mistake. It would be a mistake to sell this when the market is having this kind of disruption. And my point is, over the course of your investing life, the market is going to do the same thing. It's going to have times when it's ridiculously high for no good reason because the government is putting money into people's bank accounts to go spend money, which is making all of the stocks, all of the asset prices go up, 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 because everything's going to go up, up, up until they start to raise interest rates and inflation starts to take over. And then the government, the federal bank, the Federal Reserve, and every country around the world is going to have to respond. And when they respond, it's like the arsonist who causes the fire, and then they come and the same person is the fireman, and they're going to put out the fire for you. That's what happens. It's over and over. It's a pattern. And what happens when inflation goes up? Now remember, this market, look at that market less than a year ago, it was too high. It had gone too high because the governments around the world were helping people. They closed down the economy and then they just started giving away money. What do people do when you receive free money? You go spend it. And when you go spend it, what happens to all the company stocks that are benefiting from selling their products at a very high level? They get to raise their prices, sell more stuff, and the stock market, asset prices go way up. And then what happens? The government has to come in and take some corrective actions. The Federal Reserve, the U.S. Treasury, they start to do things to cut back the steam in the economy, because they have to do something to curtail inflation. This is a repeatable pattern, and dollar cost averaging gives you the opportunity to systematically take care of it, just to continue to invest. Now, that's dollar cost averaging. I want to jump over to the final. We're about out of time, but I'll just tell you this one's super easy. It's portfolio rebalancing. Let me get down the list. Portfolio rebalancing maybe seem kind of boring, but there's a good circle. So that's just a circle. That represents your portfolio. And just like I said before, in your 401k, you're going to have to select which asset classes you want to invest in. It won't be cows, won't be chickens, won't be pigs, but it'll be it'll be bonds. This is not a good chart. Mutual fund is a type of investment. It's not an actual asset class. Bonds, T-bills, IRAs. My guy who drew this, he wasn't an investment guy, so that's a bad chart. Let me just draw a circle. This is your portfolio. So you've got large cap, small cap, and you guys are going to do this in your assignment. You're going to have to understand enough about asset classes to know what you're going to put in your portfolio. It's not difficult. You'll learn it in your money study group. And then we got bonds. And let's say international. Sorry about that. So you see, you've got 4 quadrants, right? Well, what happens is, like what happened this year with bonds, is this number right there, everything's gone down. But bonds are now a much smaller part of your portfolio because they've shrunk so much. So what happens when you rebalance is you just put everything back in balance. And so today we would buy the bonds. Let's say today we decided to rebalance our portfolio. This is portfolio rebalancing. You're going to want to do it a couple times a year, once a year. The frequency isn't as important as understanding the idea. Over time, asset classes have big swings, just like those cows. So when you find that your cow, the part of your portfolio, the bonds, whatever asset class it is, has shrunk dramatically, that's a good time to push the button and rebalance your portfolio. What happens then? Those asset classes that are high, they get sold off so you can buy more, balance your portfolio of those asset classes that are lower. Does that make sense? It's a very simple concept, portfolio rebalancing. And when you put all these together, diversification, asset allocation, which is the most important determinant of your portfolio's returns, dollar cost averaging, which is the most powerful strategy for building wealth for young people who can invest over time because the market goes up and down. And then add that to portfolio rebalancing. Do all those things in your 401k, taking advantage of the perfect investment. I promise you, over time, you will build wealth. It starts by earning a good paycheck, saving more than you spend, investing wisely using these strategies. That's your plan. That's your financial plan in a nutshell. And if you'll do that, I'll show you in your financial plan how that pays off over the next couple of decades in your life. So we'll see you next week. You'll see the assignment posted in Blackboard. We've run out of time, so thank you guys for your great attention. I'm going to jump over and end the Facebook and YouTube. If you're visiting on Facebook, YouTube, thank you. Leave a comment, like the video, share it with a friend. Join moneystudygroup.com anytime you want.